Good morning, ladies and gentlemen. Thank you for participating in Bullion Management Group's Gold, the Money of Last Resort live webinar with speakers Paul D'Souza and Nick Barisheff, President and CEO of Bullion Management Group, Inc. Please begin, Mr. D'Souza.
Thank you. Good morning, everyone, and thank you for joining us today as we discuss why gold is the money of last resort. My name is Paul D'Souza. Before beginning, I'd like to start with a few words of warning. Learning to see gold as money is not as easy as it first appears. Ultimately, learning to treat gold as money requires more than just changing a few opinions or surface perceptions. It's like realizing that the planets do not revolve around the Earth, but in fact, all the planets revolve around the Sun. We've just come through over 40 years of dominance by an all-encompassing monetary system that depends on confidence alone to sustain itself. Today, there are no currencies that are redeemable in gold or anything else. It should therefore come as no surprise that we have been subjected to relentless propaganda that supports this baseless monetary system. Therefore, to see gold as money requires more than just accepting a few new ideas. It requires the replacement of an entire mindset that has taken decades to develop. I would now like to welcome Nick Barisheff, President and CEO. Nick will speak for about 40 minutes, and then we will open up to a question and answer session where you can submit your questions via the Q&A module on this site. Nick, welcome.
Thank you, Paul, and thank you, everyone, for joining us today. I hope I'll be able to give you some good insights into the entire gold story. What I'm going to talk about today is why gold, what the major trends are that affect the gold price, what an appropriate portfolio allocation should be. We'll give you a bit of a commercial on BMG's products, and also give you some insights into what our thoughts on the future of gold are. As by way of background, Bullion Management Group was formed in 1998, and it took until 2002 to launch our first fund, the BMG Bullion Fund, which invests in gold, silver, and platinum. In 2008, we launched our Bullion Bars program, which allows investors to buy individual bars of gold, silver, and platinum and store them on a fully allocated basis with the Bank of Nova Scotia. And in 2009, we launched our gold-only fund. We have about $460 million in assets under management, and that's held by about 8,000 investors globally. And in Canada, we're approved by all the major banks and brokerages. So on the issue of why gold, most people are familiar with the fact that gold has been on a steady rise since about 2001 and has increased by about 403% over this period. What is less obvious to many people is the significant outperformance of gold versus virtually all of the other investment classes. In this chart, you can see that during the same period, the Dow has generated a total return of 5.2%, 30-year bonds of 20%, and even the MSCI World Index at 15%, and the commodity index at 34% compared to gold's 401%. To understand why this is happening, it's important to understand that this price rise and outperformance is not because husbands and boyfriends all over the world have run out and bought jewelry for their girlfriends and wives. It's because gold is again becoming an anti-currency and has always been, money for over 3,000 years. And when people ask me, well, how is that? Gold's an archaic relic that has no place in today's financial system. There are 3 points that basically contradict that view. Firstly, gold is traded on the currency desks of all the major banks and brokerage houses. It is not traded on the commodity desks besides nickel, zinc, and lead. In London alone, the physical turnover of bullion by the members of the London Bullion Marketing Association is over $20 billion daily. the volume is estimated at 5 to 7 times that amount. It should be clear to everyone that that's not jewelry demand. And central banks still hold gold as part of their reserves. And if you look at 1980, central banks held about 32,000 tons. Today they hold about 30,000 tons. So while some banks have sold, others have bought. And as of last year, central banks became net buyers of gold for the first time in decades. So what's really happening in terms of once you start looking at gold as money is that it's not so much that gold is rising in price, but that the currencies are declining. This chart shows how all the major currencies, the US dollar, Canadian dollar, euro, pound, yen, have all declined by similar amounts between 70 to 80% since 2001. And to understand why this is happening, it's really important to understand what inflation is. Now, most people think inflation is a rise in the prices of goods and services. But in fact, it's an increase in the currency in circulation that results in a rise in the prices of goods and services. So as you print more money, and it doesn't matter whether you call it quantitative easing or not, as you have more money in circulation, eventually it leads to a rise in inflation. And when you look at the period of time from 1971, when Nixon removed the gold backing from the US dollar, inflation has risen about 463% during this period of time. But when you look at what happened to the gold price, you can see that gold has dramatically outperformed inflation and more than maintained its purchasing power over the years. Now, one of the issues is what inflation is, and there's a lot of debate about that, but John Williams of Shadow Stats reconstructed the inflation numbers based on the previous formula, which dealt with a fixed basket of goods and services and was meant to maintain a fixed standard of living. Since the late 80s, they've changed the methodology for measuring inflation, and you see this fairly significant diversion in what inflation would be according to a fixed basket of goods and services and the inflation rate that is currently quoted. So right now, instead of a 1.7% inflation rate, the real inflation rate is already over 9%. This is corroborated also if you look at various individual commodities over the past year. So you can see they're all in double-digit amounts, and eventually this is coming inflation when these go through the entire production system. So you can see that inflation is not going to be very low or continue at the 1% level as these prices go through the system. With that, it's important to get an accurate view of both inflation and how we measure return on investment. And our contention is that the best way to do that is to, change your mindset and measure things in gold terms. When we measure things in dollar terms, what happens is we get various asset classes competing with one another like a kayak race. Sometimes one's ahead, sometimes the other is ahead. But when we look at things in gold terms, we get a different picture entirely. This takes into account inflation, and we get a different barometer in terms of what inflation is and what holds its value. So to put that in more common terms, if we look at gold's purchasing power over the years, in 1971 it took 66 ounces of gold to purchase a car. Well, today it's only 10 ounces. An average house costs 703 ounces of gold, and today it's only 246. And the Dow was 25 ounces of gold, and today it's only 8.25%. Looking at more recent events, if we look at the performance of the Dow this year, it appears that the rate of return was 6.2%. However, if we look at the Dow-Gold ratio, it has declined from a peak of 10 down to about 8.2, which gives us a 15.6% decline this year. If we move on to the trends, well, a rising gold price is basically a demand factor right now, but the demand is coming from investors such as John Paulson, George Soros, Paul Tudor Jones, David Ihorn. They've all taken very large positions in gold. The central banks have become net buyers, particularly China, Russia, and India. And we even have now institutions taking substantial positions in gold. The Texas Teachers Pension Fund bought $400 million last year. Northwestern Mutual Insurance, which is the second largest insurance company in the U.S., also bought $400 million. Even though those numbers are significant, these are still very small percentages of their total portfolios. Where this is going is that the rising gold price and basically investors' loss of confidence in the currency systems, including the U.S. dollar. In 2009, the federal tax revenues in the U.S. was about $2.1 trillion, but the total liabilities, including unfunded social insurance and Medicare, totals about $120 trillion. So you can see that it's going to be very hard to manage the debt situation. The other problem looming in the background, we had a taste of it in 2008, but there's about $600 trillion of derivatives. If there was to be another meltdown in the derivative sector, the government is likely going to have another bailout of the financial institutions involved. The other trend is the exponential increase in money supply. Although it's pulled back a little bit from its rise since 2008, the increases are substantial. When you consider that in 1971, the total money supply was under $800 billion, and now the annual increases are nearly twice that amount. You can appreciate how exponential this growth has become. What this translates into, from a long-term perspective, is looking at the Dow-Gold ratio. These are the macro trend changes that indicate when portfolios should be overweight tangible assets and when they should be overweight financial assets. When the ratio is rising, as it was in the late 20s and the 50s and then the 80s and 90s, portfolios should be overweight financial assets. But when the ratio is going down, the allocations need to change dramatically to be overweight tangible assets, particularly precious metals. We peaked out in 1999 at about 40 to 1. And since then, this has been declining, and we're currently at about 8 to 1. And many observers and followers of the Dow-Gold ratio, such as Richard Russell, expect that the ratio will drop to 2 to 1. In simple terms, what this means is that if you'd invested 40 ounces of gold in 1999 and cashed in your investment today, you would only get 8 ounces back. That's quite a loss in real terms. This chart, as many people ask in terms of the various reasons why one would buy gold, but one of the reasons that people buy gold is for crisis protection. This chart shows you what happened to the gold price versus the equity markets, and all of this is calculated in the currency of the country. So in 2008, we experienced very dramatic declines in equities, while at the same time we had the opposite effect in the gold price and the currency. The only exception was Japan, which, because of the yen carry trade, experienced an increase in the value of the yen against gold. But even so, the loss in gold was much less than the loss in equities. Over the very long term, when people ask what's going to happen to the price of gold, apart from the quantitative easing and the printing of money, what needs to be understood is why the government will not be able to reduce the spending and reduce the quantitative easing. And on a macro basis, there's three trends that are driving this. The first one is the aging baby boomer population. And the effect of that is as people age, they downsize and reduce spending. And as they retire, they start drawing their pensions and get Medicare benefits and so on from the system. So this results in a double whammy effect. It's lower tax revenues for the government, while at the same time further expenditures. The second trend is the issue of outsourcing. That right now the true unemployment rate is running close to 20%, and many people expect that when this recessionary cycle is over, then everything will get back to normal. But other observers are looking at the fact that the current unemployment rate is systemic and likely will rise. And that is all due to outsourcing. More and more jobs are being lost in the Western and North American countries to countries with lower labor rates. When you consider that a North American worker makes about $20 an hour plus $10 an hour in benefits, whereas a Chinese worker makes about 80 cents an hour without any benefits, you can see that this trend to outsource will likely continue until the price of oil is so high that it's not worth shipping the products over anymore. Then we might have a revival in manufacturing in the Western world. The third trend is the issue of peak oil. This doesn't mean that the world is out of oil, but generally speaking, when oil wells reach about 50% of reserves, production starts to decline. And as it declines, then we get less and less oil from a production point of view. And at the same time, right now, we're experiencing increases in demand, particularly from China and India. When we have those two trends put together, and because oil is used in everything from manufacturing to transportation to agriculture, we'll have another inflationary force as the price of oil rises. The trend, although we peaked out at $150 a barrel, is now steadily climbing, from its recent lows, and we're now approaching $90 a barrel, and many expect that we will be looking at $100 oil next year. When you put those trends together, what happens is that you end up with lower GDP, lower tax revenues, higher trade deficits, high systemic unemployment, increasing money supply, rising inflation, declining currency's value, and all of that results in higher gold prices. So when you look at that and you say, okay, well, how much gold should a portfolio have? The first issue is that gold is a portfolio asset. So what we're primarily using it for is diversification. And that is because it is the most negatively correlated asset class to traditional assets. If portfolios are made up of just stocks, bonds, and cash, they are not diversified, they're not balanced, and they have no negatively correlated assets to reduce risk and reduce volatility. So by inserting gold into the portfolio, we both reduce risk and volatility. So how much gold? Well, from a strategic point of view, we did a study by Ibbotson Associates in 2005 to look at how much gold would be necessary just to have a diversified, balanced portfolio. Their conclusions was that a conservative portfolio made up of mostly bonds would need a 7% allocation, and an aggressive portfolio with higher allocation equities would need 16%. So that's a minimum starting point. From a tactical point of view, just to protect from inflation, Wainwright Economics has done a number of reports, and first of all, they conclude, A, that gold is a leading indicator of coming inflation, and from that, they then look at how much gold would be necessary in a bond portfolio and an equity portfolio to break even from an inflation point of view. Their conclusion was that in a bond portfolio you would need 18% allocation, and in an equity portfolio you would need 40% allocation. Now at this point many people fall off their chairs in disbelief at 40%, but if you look back to the 1970s, the Dow was basically flat between 1968 to 1982, and on an inflation-adjusted basis didn't break even until 1995. At the same time, gold increased by 2,300%, and inflation ended up running at over 15%. Had investors allocated 14% in the 70s to their equity portfolios, they would have been likely even throughout the period. So that's why the allocation is so high, because of those kind of trends. In terms of where it fits in let's say, the gold investment pyramid, because some people confuse different forms of gold and assume that mining stocks are the equivalent of gold. All those are different asset classes. So from this chart we can see as we go up the pyramid, the risks increase, and as we go down, the liquidity increases. At the bottom of the pyramid, what we have is not investments, but money. And physical allocated bullion should form part of the foundation. Now, in terms of our little commercial in the process, in terms of what we've tried to achieve in our products is that all products would maintain the three attributes of bullion itself. And those attributes are liquidity, independence of management skills, and no counterparty risks. Because the fund is an open-end trust where units are purchased and redeemed, we maintain basically the same liquidity as bullion itself. We buy bullion from the markets and we sell back into the markets. Funds that are listed for trading have the liquidity of whatever the trading volume is, which is largely dependent on the size of the fund itself. We will always be priced at net asset value by formula, so there'll be no fluctuations in premium and discounts. We also, in terms of number two, we're independent of management skills, so we purposely have a fixed investment policy. So as money comes in, we simply buy the bullion at prevailing prices at the time. We don't attempt to market time, hedge, lease, rebalance, leverage, any of those issues. At times they may enhance returns, but at times managers can make a mistake, and therefore instead of having a bullion investment, you have an investment in the skills of the manager. We also ensure that there's no counterparty risk, so we don't use any form of proxies or derivatives. We simply buy physical bullion, and then once our accounts accumulate to where we have bars, we then have an allocation of the bullion and held on a fully allocated basis after that. We don't use any kind of certificates, proxies of any kind, and we don't invest in any mining stocks as well. As I mentioned earlier, we have two funds right now. One invests in gold, silver, and platinum. Then we have the gold bullion fund, which invests in only gold, and we're planning to launch a silver-only fund sometime in 2011. And as I mentioned, our bullion funds maintain the attributes of bullion in terms of liquidity. There's never any liquidity constraints. We're always priced at net asset value. We're purchased and redeemed at net asset value. Never any premiums or discounts. We're independent of management skills, so we always track the price of gold precisely, and there'll be no surprises due to hedging, leasing, timing, etc. There are no counterparty risks in that, first of all, the fund itself, as an open-end mutual fund trust, is secure from any third-party claims. Bank of Nova Scotia acts as custodian for the bullion. RBC Dexia is the fund administrator, so they do all the fund accounting as well as set the net asset value per unit every day, and they also act as a sub-custodian for the fund's cash. The assets are audited annually by KPMG, and the bullion is held on an allocated and insured basis with the Bank of Nova Scotia. As a mutual fund, it's important to understand that the units can't be shorted, so there's no surprises possible on that end. Where traded funds can be shorted. In our bullion bars product, we offer five different sizes of bars. The 1,000-ounce silver, 400-ounce gold, 100-ounce gold, and the 1 kilo gold, as well as a 50-ounce platinum bar. When these are purchased in terms of individual bars, we issue what we call a bullion deed, which is a title document to the client. In each case, the bullion can be held in allocated storage with the Bank of Nova Scotia or delivered to the owner. And as the fund's bullion, it's all the bars are held on a fully allocated, insured basis. In conclusion, because I get asked, where is the price of gold going in the long term, and I find that the best way to answer that is to look at the comparison of bullion in terms of as a comparison against world financial assets. So from this chart, you can see that global financial assets are about 200 trillion, and this doesn't include real estate or derivatives. The total above ground gold is about 6 trillion, but 3 trillion of it is not bullion. So of the bullion, there's only about 3 trillion of above ground bullion. 1.5 trillion approximately is held by central banks, and the central banks have become net buyers. So that's not going to be available for sale. And the other 1.5 trillion is privately held. But that gold is largely held by the world's richest families, and they tend not to sell at any price. So in terms of where the price will go, how high will it go is dependent on when some fraction of the 200 trillion gets more nervous than they are today and starts moving into gold. The only variable can be an increasing price. And with that, it's a question of time before we get that movement, in my opinion. So thank you for attending today's presentation, and I'll be happy to answer any questions that you may have. If we don't get to all the questions, we will be able to email you back answers over the next couple of days.
Thank you, Nick. That was very informative. Just so everyone is aware, the replay will be available by Monday, and we will send all those that registered an email notifying you of that. Thank you. So, Nick, we've had quite a few questions. Let me just begin with probably the number one question asked is, where do you see the price of gold going in the short term, say 6 months to a year?
Well, and I did a calculation because I get asked this question so often. I wanted to have some method rather than pulling a number out of the air. And what I found was that in the last quarter of the year, the price of gold rose by about 2 times what it did in the first 3 quarters, and that's an average over the past 5 years. So if I took those numbers and took the price of gold in September and the fact that it increased by 11% to September, then if we repeated that performance this year, we would get a 22% increase in the last quarter, which would have us end up with about $1,500 gold this year. So it looks like we're on track for that. If we look at next year with the same methodology, if we apply the average increase in gold that we've had over the past 5 years and repeat it in 2011, we get a price of $1,785. If we repeat the performance of 2010, we're then at 2,000. So that's kind of as far as I think we can go in terms of near-term predictions, because so much is changing around the world daily that it's almost impossible to have any meaningful long-term projections.
Great, thank you. So we'll begin with the questions, and thank you everyone for submitting them. First question is, gold has no utility. You can't eat it, nor does it pay any income. If financial Armageddon occurs, wouldn't I be better off with cash and a shotgun? We hear this question often. Do you want to speak to that?
Well, the purpose of holding gold isn't just for financial Armageddon and, to park it beside your guns and beans, as people say. Hopefully that situation, won't occur, and if it does, it'll be years into the future. The starting point is that every portfolio needs some gold from a diversification point of view alone. And, in Canada, we've got the latest numbers I was looking at is something like $800 billion in various mutual funds, hedge funds, and so on. And at best, we may have $3 billion in gold holdings. So we're not even close to step number 1, which is a strategic allocation. The second allocation is tactical for inflation and crisis events and so on and so forth. And we're a long way off, in terms of the guns and beans scenario. So that's not something that I'm personally that concerned about in the immediate future.
Okay. Gold keeps rising in price every year, and I feel like I've missed the boat. What is a good entry price?
Well, you can almost reverse that, and the question would be more like, did you feel that you missed the NASDAQ rise at about the same time when the NASDAQ would have moved up to about 1,000, and yet had another 4,000 point move to go? We're at the very early stages, and you wouldn't have missed the boat if we were sitting here with population in Canada and elsewhere with 20 to 50% gold allocation in their portfolios. Then you might have missed the boat. But we're a long way away from that. And as we move to reasonable allocations in gold, the price will rise dramatically.
Right. And in terms of how high will gold go, I've heard you answer in terms of the question is, well, really it's a function of the currency. So you can speak to that.
As a function of currency, the ability for the currency to decline and then reflect a higher gold price gives you numbers that are beyond belief. Like if you just look at the German inflation in the 30s, the price of gold was 75 marks an ounce in the 20s, 1921. And 2 years later, it was 23 trillion marks an ounce.
Right.
So it's not so much, the gold price just maintained purchasing power or maybe a little bit above that, but the currency declined. And that's the same story all over the world. you get numbers once you get into a hyperinflation, numbers that are beyond belief. The latest Zimbabwe note that they printed was 100 trillion.
Good, excellent. Can you speak to gold trackers such as ETFs? There's been, increasing information being brought out in various gold experts discussing what ETFs are and are not, and are they backing gold? So there seems to be quite a bit of confusion. Can you speak to that?
Well, the confusion seems to stem from the fact that many investors and some advisors think that ETFs are just the same as mutual funds with low management fees. It's important to understand how ETFs are structured, and they're not remotely similar to mutual funds. In a mutual fund, investors send their money to the investment manager, and the manager then goes out and buys the assets according to his particular mandate. In ETFs, that's not the process. The process is authorized participants contribute certain baskets of assets to the ETF. The ETF issues ETF shares at net asset value, and then the authorized participants, which are mainly brokers and banks, sell those shares to public investors at some number that could be higher than the net asset value. But the important thing to understand is that the authorized participants can contribute borrowed assets to the ETF, and that applies to all ETFs. And that's the main motivation there, is that when they borrow assets and contribute to the ETF and then sell those assets to the public, they get to keep all the money. They have a liability for the borrowed assets, but currently they get the cash. To me, this is a totally flawed concept in line with mortgage-backed securities and the disaster that fell through 2008, because you're starting the process with two people having the same claim on the same asset. It's made worse because once that's done, then there's an unlimited amount of shorting that can be done from investor to investors, and then you have now multiple claims on the actual ETF shares. If ever you get a situation where some authorized participant somewhere becomes insolvent, we're going to have an ETF disaster on our hands.
Excellent. Thank you, Nick. The next question is, people who need income and who are elderly, is gold a good candidate for their portfolios?
Absolutely. If people go to our website, we have a calculator where you can plug in your own assumptions that gives you the after-tax, after-inflation performance of gold versus bonds. And what it does, by taking gold and liquidating part of your annual capital gain, you can see how the investors can maintain their annual cash flow on an inflation-adjusted after-tax basis versus getting dividends from or interest from bonds. As an introduction to that concept, people can read our latest article, which we've compared gold versus bonds and referred to this calculator. So retired investors, mistakenly think they need interest or dividends. What they need is cash flow, and the cash flow can be provided by liquidating part of the capital gains. The capital gains in gold have been, more than twice the prevailing, interest rate you would get on bonds. So you would only have to liquidate less than half of your capital gain to meet the performance you're getting from bonds.
Great, thank you. The next question is, I was told that keeping physical bullion at home is the only way to be assured that I owned it. How do investors know the bullion is stored with you or with Scotia, and why should I pay for storage if I can keep it at home for free?
Well, keeping it at home has a number of risks. First of all, it's not insured. No one will insure gold stored either at home or in a safety deposit box. So that's one of the issues. If you're the amount of the investment you have is relatively modest, well, that can work. If you have a few $1,000s in coins and wafers, you can hide those in the backyard or bury them somewhere, and they'll be there at no cost. But once you get into sizable allocations, it's simply not practical to store bullion at home. And the issue of storage isn't somewhere where you should look to save money on. It would be like buying life insurance from the cheapest insurance company, and then when your house burns down, you find out that they're insolvent as well. So this isn't the area to save money on. It's important to have credible allocated storage. And in our case, for both the funds and the bars, we post all the bar holdings on our website, and we include all the details: serial number, exact purity, exact weight, refiner of all the bars. Those are audited once a year by KPMG, so they verify the reports that we get from Scotia against the physical holdings.
Great, thank you. Aren't the companies that actually produce gold a better way to have exposure to gold?
No, they can, at times during a rising market, can outperform gold. But for example, the period of 2006 to the fall of 2008, mining stocks significantly underperformed gold. From a portfolio perspective, although they make for good speculations from time to time, and for the right investor, they should hold both in reasonable proportions. But from a portfolio point of view, they can make matters worse. So for example, in 1987, while the price of gold was rising during the decline in the fall, mining stocks suffered twice the decline as the broad equity markets. Broad equity markets declined by about 30%, and mining stocks declined by 60%. A very similar situation in 2008 was as well, that while the equity markets declined, the mining stocks declined by more. So mining stocks do not help in terms of reducing risk in portfolios. They actually make it worse. And the reason for that is that all the mining stocks put together is but a fraction of the market cap of, say, Microsoft. So if there's any sell-off at all, the pricing on mining stocks really takes a beating. In 1987, for example, Barrick was no bid for something like 3 days. So that's why when portfolio managers, mutual funds, hedge funds get into a position where they have to sell mining stocks, the sale overwhelms the buyers, and the mining stocks take a terrific hit at the time.
Nick, can you speak to the higher MER for the BMG funds than other bullion funds in Canada?
Well, that's largely due to the fact that we're holding real bullion. We could have reduced the MER if we chose to, buy certificates or proxies or anything else. That's a lot cheaper. But because we're holding real bullion, we have real storage costs and real insurance costs.
Great, thank you. Next question is, in the slide you had discussed the Dow to gold ratio ending up at 2-to-1. What price do you see the Dow and gold in that scenario? Be a higher Dow, lower Dow?
Well, it could be both. If we get a very high inflation rate due to dramatic money printing, then we'll likely see the rise in the Dow. But the rise could be considerably less than the inflation rate. So during those periods, yes, the Dow could rise, and we could have a situation of $20,000 Dow, $10,000 gold. But from a Dow gold ratio point of view, you would still have gold outperforming the Dow.
Excellent. The next question is, isn't deflation the bigger concern at this point?
I think anybody that considers deflation to be a concern should go back and read Ben Bernanke's famous helicopter speech, because he made it absolutely clear that there will be no deflation on his shift because of the fact that he's got a printing press that can print all the money he wants. And from that point of view, and from the fact that his master's thesis on the crash in the 30s was based on the fact that the government at the time didn't print enough money, he is intent to prove his thesis. So the current quantitative easing is just step one of this process. And in his famous helicopter speech, he said, if there aren't any new borrowers for us to print money for the new lending, the Federal Reserve can go to the market and buy mortgages, which it's already done, and it's bought toxic mortgages. It can buy bonds, it can buy equities, and if all else fails, it can throw the money out of helicopters. So those thinking that there's going to be deflation are betting against the Fed, and they have control of the money supply, and they intend to print as much as it takes.
Right. Great, thank you. Nick, do you see the devaluation of the U.S. currency as a way to stem the outsourcing over the long term in order to bring, I suppose, the manufacturing back on board with lower wages?
Well, but this is where we're going to get currency wars, where if the U.S. continues with this, then other nations will be devaluing their currencies, and this is already starting to take place. And all that's going to happen is all the nations are going to be devaluing their currencies against gold.
Right. Nick, we had a question, actually, something that occurred what seems like at least a year ago regarding Harvey Organ interview on King World News. So the question is, what came of that? Apparently, I guess the person asking this question hasn't heard the two interviews that you've done on Financial Sense.
Well, the issue is a kind of a ludicrous situation that it's hard to understand why, and it wasn't Harvey Organ, I believe it was his son, could possibly have made the contention. We've been in the vault numerous times with our auditors, so apart from our own gold and silver and platinum, there's significant holdings of other people's gold. I think there might have been some confusion is that if the organs owned allocated gold versus unallocated gold. And in my conversations with Scotia, their contention was that what he said was simply not true. And I don't know if they've taken any legal action against him, but it was just ludicrous comments that were made. So.
Right after that occurred, there's Nick, just for everybody listening, Nick spoke on Financial Sense in two separate interviews, and I thought did an excellent job of explaining exactly how the process works and pretty much set the record straight. So look in our media section of our website under Financial Sense interviews, probably under Scotia. You can find those two excellent interviews. The next question, Nick, if we continue going, there's many questions, is platinum and silver. Can you speak to that in terms of its potential, given it's a dual commodity, in terms of a commodity, industrial commodity, and a monetary metal?
Well, the reason I initially set up the tri-metal fund was by having all three metals that at times you would benefit from the industrial commodity demand on particularly silver and platinum, and at other times you'd benefit from the monetary demand, which is particularly gold and silver. If you looked at the history up until the 2008 crash, the performance was platinum, silver, then gold. And each case, you have different attributes of the metals. Apart from the industrial demand, is that silver has so many industrial uses that they're even hard to count, and there's more patents being applied, almost daily. The above-ground silver is almost non-existent in terms of anything, and the mine supply is in a deficit. So up till now, what's kept things together was a certain amount of scrap supply. The U.S., for example, owned 2 billion ounces of above-ground silver in 1980, half was in strategic reserves and half was at the U.S. Mint. Now both of those have been fully depleted, and the U.S. Mint has to buy silver, and strategic reserves for both silver and platinum are non-existent. So likely you would see the demand for silver from both a monetary and industrial point of view increase. And what's important there is that because so little silver is used in any of the products, that it's basically price inelastic. For the minuscule amount of silver, for instance, in your cell phone, it's not going to make any difference whether the price of silver is $20 an ounce or $200 an ounce. So that's one of the important mechanisms. The second thing is that most of the silver supply, something in excess of 70%, is a byproduct from other metals. So even if the price was to rise, you're not going to be able to dig up more, zinc or lead and get the 5% silver content. So the supply is going to be relatively stable. Platinum has a unique situation. Its main industrial use is for catalytic converters for diesel cars. Palladium can be used for gasoline cars, but platinum can be used in either gasoline or diesel. Most of the rest of the world is on diesel. The problem is that as we get higher and higher demand, we have a problem in that the concentration of supply is primarily in South Africa. 80% of the reserves, 80% of the production is in South Africa. The next place is Russia with 15%. And if there's any disruptions like we experienced in a couple of years ago when South Africa had electrical supply problems, the price goes ballistic in a matter of months. So down the road, what the driving factor for platinum is going to be is probably supply shortages or disruptions coming from either South Africa or Russia.
Great, thank you. Nick, can you speak to the concept of peak gold?
Well, I think the concept of peak whatever, gold, oil, can be applied to most commodities. There's even a book written called Peak Everything. So we're at the point where, as the world's population is increasing, we're peaking out in a lot of critical commodities. So as we go forward, we're going to probably see significant price increases across the board in commodities. And gold's in the same position. The major metals have pretty much peaked a few years ago, and there have been no huge mines found, just the same as there's been no huge oil wells found.
Nick, the next question speaks to rebalancing in the fund, and as discussed, that would compromise one of the three attributes of bullion. Can you speak to that further in terms of why we don't rebalance?
I think, in my view, the fact that we simply buy what's there and not rebalance is that nobody, including us, has a crystal ball. And 2008 should have taught us that the most brilliant minds and the sharpest guys in the hedge funds and so on can make huge mistakes. And with gold holdings, it's important that that's not a risk for investors. It's simply a gold investment, and you don't want to have a surprise that the manager did the wrong thing because he wasn't expecting some event to happen.
Okay, well, that's all the time we have for it. Thank you, everyone, for all your questions. If we didn't get to your question, we'll have someone from our offices contact you. There's been several questions in terms of Wainwright reports, etc., so we will get those out to you. If you'd like any further information, please contact our office, visit our website, and we'd be happy to talk with you further. Thank you very much.
Thank you, ladies and gentlemen. This concludes the live broadcast of Gold, the Money of Last Resort, presented by Bullion Management Group, Inc. The replay of this webinar will be available at www.bmgbullion.com, and that's www.bmgbullion.com.